Welcome back. This is chapter number 2, class number 1. Up till now, we've given you some basic entry-level information on trading and day trading, but today, this is probably one of the most important things you need to get a hold of and understand well to be profitable in day trading. So what are we going to be talking about? We're talking about risk management, how to manage your risk when you are in a trade. The areas that we're going to be focusing on today, first, we're going to look at our risk to reward ratio. We need to understand how much we are risking and what our potential profit target is when we enter a trade. We are also going to talk about account management and also position management. And then we're going to end this class with scaling up. Now, although this is going to be a little bit shorter class, if you can get a hold of the information and really understand how to manage risk, you can be successful as a day trader or trading in the market in general. Before we go too far, I know I'm going to sound like a broken record here, but if you are new into trading, please start in a paper trading or a sim trading account. If you haven't already gone through our class, we do have a paper and sim trading. There have been people that have said, paper trading isn't exactly like trading with real money, and that's true. With paper trading, it doesn't function the same in the sense that if you have an entry, regardless of how many shares you plan on buying as a paper trading account, your order is going to be filled. It's not always the same with real money. However, what I would encourage you to do if you are starting with a paper trading account, make sure that you are paper trading the same amount or the same share size that you would trade with real money. It gives you more of that real mechanics. They've also said that paper trading doesn't really reflect slippage. So what is slippage? Slippage is when I hit the buy button, if I want to enter at $5 a share, time my order goes through, I hit the button and it actually goes through, I might actually enter at 503, 504, 505. That difference between where I planned on buying and where my order was actually filled, that's considered slippage. With a paper trading account, slippage doesn't exist because when you hit the buy button, it is automatically filled. However, with paper trading, it does give you the opportunity to experience how to do trading with no risk. It gives you that practice. The other thing that it gives you is muscle memory when entering and exiting trades and how to quickly make those decisions. And it helps you with that emotional tolerance. When the excitement of a stock that's going up, it does help with that. I don't want to be a broken record, but again, if you are new to trading, please start in a paper trading account. Here's what we need to understand with managing risk. So successful traders, they are really risk managers. I've had several people ask me, first, isn't day trading just gambling? Or really the question I get a lot of times, should Christians gamble in the stock market? Well, let's define a couple things here. It's really not gambling if you are managing risk. Traders typically think about risk, whereas gamblers simply think about profit. One thing that we need to understand is that profit is simply a byproduct of being good at managing risk. So if you don't know your risk, or if you don't know how to manage your risk, you really are just simply gambling. However, if you understand how to manage the risk when you are in a trade or about to enter a trade, it's not gambling. It really becomes a business. So traders think about risk. Gamblers simply think about profit. Please keep in mind that profit is simply a byproduct or a result of being good at managing risk. So let's take a look at the difference between somebody who is a trader or gambler in the stock market. So somebody who is as a trader, we have very sound risk management. We have a plan in place. We're very strict with our risk management. Whereas a gambler, there really isn't any risk management. They just enter into a trade hoping that it's going to go up. Also, traders typically have a proven trading plan, either by learning from somebody who is successful or testing in a paper trading account your strategy, whereas a gambler has no trading plan. They just, again, are buying shares hoping that it's going to go up. Now, a trader will master one strategy and maybe know and function very well in different strategies, but are very strong with one specific strategy and know others. Whereas a gambler, they're just going to buy shares because they heard of a recommendation. I heard this stock was going to go up, so they end up buying it. Or they get a trade alert, they buy into a stock and end up losing on it. They simply go by whatever recommendations without understanding the risk that they're getting into or why they are buying that stock. So traders trade without emotion. This is simply a transaction. It is a business transaction. I buy a stock at a certain price and projecting that that stock is going to go up and sell it when it hits a profit target. So there really isn't any emotion if we understand. Now, is it exciting? Absolutely. However, the emotions aren't there as much simply because we see it as a business. Whereas somebody who's gambling, they actually trade completely on emotion. And what I mean by that is they'll buy into a stock because maybe a fear of missing out or that emotional greed that we've talked about in previous classes. So gamblers will simply buy into a stock based on a feeling or a reaction. Remember, our choices are typically dictated by the emotions that we feel. If we remove those emotions and it becomes more mechanic. So gamblers will typically trade based on emotion. A trader will journal every trade. We've talked in previous classes about several options for you to journal your trade, including the Kingdom-Minded Traders Trading Journal. Whereas gamblers, again, they don't journal. They just simply buy and sell stocks. Traders see this as a business, whereas a gambler will open too many positions. They buy too large of sizes. Again, there is no trading plan. And we're all going to have losses in the stock market. If you are just getting into day trading, you are going to have days where you lose money. But the key to that is learning from your mistakes. So a good, strong trader will learn from their mistakes and put guardrails in place to keep them from doing that. Whereas a gambler, there is no discipline. Again, they are chasing profit. So traders manage risk, and from that, we are profitable. Whereas gamblers, they are chasing profit with no risk management. So the first thing we want to get into in this class to understand how to manage risk is our risk to reward ratio, our R&R. When you start learning day trading, there's going to be different terms that you're going to learn, and this is one of them. So our risk to reward ratio. So we need to understand, successful traders, if we're managing risk, we need to understand this. This is really important key. Risk is the only factor that you have 100% control over. In other words, if you buy into a stock, you cannot control how many other traders are coming in. You can't control the volume. You can't control the price action on that stock. The only thing that you have 100% control over when trading is the risk factor. So we need to be able to identify and define what risk is when trading. So risk is your entry price minus your stop loss times the share size. Let me say that again. Risk is equal to your entry price minus a stop loss price times the amount of shares. So as an example, let's say we have a $5 stock and we set our stop loss at 485. So that tells us that we have a 15-cent stop loss. So when we enter into the trade at $5, we already have in mind a set stop loss in this trade at 15 cents. If the trade goes against us 15 cents below our entry price, we are going to sell and get out of that position. And in this case, if we did 500 shares, our risk on this trade would be $75. So risk is our entry price minus wherever we have set our stop loss. In this case, it is at 15 cents times the amount of shares. And at this one, it is $75. That is our risk, our maximum risk that we are going to make or lose on this particular trade. So if we understand how to factor in risk, how does that play out overall in trading? So if we look to our risk to reward chart, we need to understand this. If you have a 1-to-1 risk to reward ratio, in other words, maybe it's $1 to $1, maybe it's $100 to $100, $1,000 to $1,000, whatever that may be. But if you are risking $1 to make $1, that means you have to be right 50% of the time in order simply to break even, not to be profitable, but just to break even. If you are risking $2 to make $1, that means you have to be right 67% of the time simply to break even. If we go up and if you risk $3 or $300, whatever the number is, to make $1 or 100, that means you have to be right 75% of the time in your trade in order simply to break even. So what we want to look at is we want to really focus in on these 4 tiers. Now, it's great if you can get a 1 to 5, a 1 to 10, 1 to 50, and it does happen. Those are the home runs that we've talked about. But if we are looking at simple base hits, daily and consistently hitting base hits, if you can get a 1 to 2, a 1 to 3, or even a 1 to 4 risk to reward, watch this. If I risk $1 to make $2, I only have to be right 33% of the time to break even. In other words, if I have a 1 to 2 risk to reward ratio, and let's say my accuracy is at around 50%, that means that I am profitable. Now, just before recording this class, I pulled up my matrix, and through this year, 2025, I'm currently sitting at a 69.8% accuracy with a 1 to 3 risk to reward ratio. So that means I'm profitable. If we had a 1 to 3, so $1, we're risking $1 in order to make 3, we're risking $100 to make 300, maybe we're risking $1,000 to make 3,000. In this case, we only have to be right 25% of the time in order to break even. So if you are right 30% of the time with a 1 to 3, that means you are being profitable. So whenever you enter a trade, you need to know what your risk factor is and where your exit for a stop loss and your exit for a profit. If you go to a 1 to 4, you only have to be right 20% of the time. If you hit that 1 to 5, you only have to be right 17% of the time in order to break even. If we look to our risk to reward ratio chart, again, this is break even. Where we want to focus on is that 1 to 2, 1 to 3, and 1 to 4 risk to reward ratio. So we're really talking about accuracy and setting stop losses. So if we look at our risk to reward, if we have an entry, again, we're going to use the same numbers at $5 and we set our stop loss at $4.85. and we know that it's at 15 cents. So we're going to lose 15 cents on 500 shares. Our risk in this trade is again $75. Now let's apply that to the risk to reward ratio. If we did a 1-to-1, so I put in $1 and I'm making $1, and we're right 100% on this, that means we've made $75 rather than losing. That's a 1-to-1 risk to reward ratio. Now, if we just double that, we risk 1, so our risk to reward is a 1-to-2 risk to reward. That means rather than making 15 cents a share, we've now made 30 cents because our stop loss was 15 cents. Our 1-to-1 is 15 cents. Our 2-to-1 is a 30 cent on 500 shares. So that means that we would have made $150 on that trade. If we have a 1-to-3 risk to reward, so we risk $1 to make 3, that means that we are at a 45 cent per share that we've gained at 500 shares. We made on one trade $225. And again, if you increase that to a 1-to-4 risk to reward, that means we're making 60 cents per share. That's a $300 gain. Now, if we doubled this, let's say we were doing 1,000 shares, this bottom one would be then $600. So again, our whole point is to focus in on the 1-to-1, but hopefully a little bit better, really at a 1-to-2 to 1-to-3 or 1-to-4 risk to reward ratio. In other words, every dollar that I'm risking, I'm making $2, $3, or $4 for every single dollar that I am risking. And how we do that is making sure that we set both stop losses and profit targets. Now, I've had several people ask, well, why do you set a profit target? Why don't you continue to let the stock go up? That is typically a very good question. However, here's why. Because if I can hit consistently a 1-to-3 or 1-to-4 risk to reward ratio and my accuracy goes up, could I potentially make more on a trade? Absolutely. But just as quickly as that stock goes up, it could turn around and actually halt down. So my thought is to be a good steward of what we are trading and the money, because technically we are trading with God's money. To be a good steward, we need to be able to set not only a stop loss, but we also want to set a take profit mark. So when we look at that, again, key components of being profitable, to understand risk to reward. So if we look at key components of being profitable, here's where we need to start our focus. Our focus needs to start with high accuracy. In other words, the being right more often in our trade, looking for those A+ setups, the ones where we see volume coming in, the relative volume is there, there's an increase or a gap from the day before. We want to look for those A+, those quality setups, and look for accuracy. Then the second part we really want to focus on is that profit loss ratio. So the more accurate you are, the better your profit loss ratio. Then that drives us down to being consistent. If you can consistently have high accuracy, consistently have a 1-to-2, 1-to-3, or 1-to-4 profit loss ratio, then what we can see is then your accuracy is going to increase even more. The more your accuracy increases, again, the higher your profit and loss. So if we understand we need to start with high accuracy, that is our focus as a beginner trader, quality setups, and following that profit loss at a minimum of maybe 1-to-2 to 1-to-3 profit loss ratio. And maybe you're doing these with a small size, but here's what you're creating: consistency in trading. This is the difference between being a trader and a gambler with day trading. We understand now how to figure, how to determine what our risk factor is and how that equates into a profit loss ratio, and where our focus should be on high accuracy, a 1 to 2, 1 to 3, 1 to 4, and when the home runs come, it's higher. That's great, but being consistent in that, then we can really look to account management. The important part of account management, here's probably the number one question I get, especially from new traders. They will ask, how much do I risk with a small account? So if we're talking about account management, as a beginner trader, I would definitely start with less than 100 shares. You might even start with 5 shares, 10 shares, 20, but start at least under 100 shares per trade that you're getting into. The reason we do that, if you're doing 100 shares and maybe you have a 15-cent win, you're going to make $15, and you think, well, that's really that's not enough really to be profitable. You're right. Right now, it may not be extremely profitable, but again, what we're looking for to start trading is high accuracy, a high profit and loss, and consistency. So to start trading, if you have 100 shares, though, here's where we talk about account management. If we have that 15-cent loss, then we've only lost $15 on that trade. If you are an intermediate trader, you've been trading for a little while, I would definitely start with less than 500 shares. Again, 500 shares with a 15-cent win on 500 shares, that's $75, but your max loss on that would be also $75. So intermediate, maybe bump that up to 500 shares. If you are an experienced trader, we typically recommend that you trade no more on any single one trade or entry 1 to 2% of your entire account size. So how do we manage our accounts? You start with smaller shares because we understand that that's going to be a smaller amount of loss. You have a very set, strict stop loss and profit taking point. Intermediate, again, under 500 shares. Experienced traders, I would stay within 1 to 2% of your entire account balance per trade. And early trading, this is, if you are new at trading, this is crucial. You want to focus on that consistency. Consistency with the profit to loss ratio being a 1 to 2, 1 to 3, 1 to 4 profit loss ratio, and consistency with that accuracy. So account management, start small. You can always increase, and we're going to talk about that here in just a moment. We understand how to manage accounts. We really also need to understand how to manage our positions. So when we are in a trade, how do we manage them? So I put this graph on here because most people that get into trading, of course, they've watched all the videos on YouTube and all these guys that saying they're making the millions. Maybe they are, maybe they're not. But trading doesn't work on a straight line. So as you start trading, you start making more money, you start making more money, you start making it doesn't work like that. When you first start trading, maybe you're trading with 10 to 20 shares. You're not going to necessarily be profitable right away. In fact, you probably, as you start trading and trading those small sizes, might see a small dip and it's going to level off. But as you become more consistent, as you understand and can control and manage that risk, that 1 to 2, 1 to 3, 1 to 4 profit loss ratio, and you start adding shares, you will see that profit line increase dramatically, and it actually happens very fast. If you haven't watched Introduction to Day Trading, I actually share how I got into day trading, and all of this started with a check for around $1,500, and I've gradually, over time, built that up. It wasn't an overnight success. Keep in mind, trading is a marathon. This is not a sprint. And if you are good at managing risk, you're going to make it a long ways in this marathon. But then as you begin to add shares in those positions, You get larger and larger and larger positions, you will then see that profitability. And when it starts to increase, it actually happens very fast. So when I am in a position, here's one of the questions I get so often. When I'm in a position, we have charts going, we have indicators going, maybe you have alarms and alerts going off. Where do we focus our attention when we are in a trade? I thought that that's a great question, so I wanted to put this in here. So this is level 2, and later on chapters, we're going to have a very deep dive into level 2. But when I am in a position, I'm watching the charts to determine a position. Now, keep in mind, charts are a historical record of what has happened with the price action. Level 2 shows us future action. And what I mean by that, all of these are orders. This is Thinkorswim's level 2. All of these are orders, people that have put out a bid to buy shares. So we can understand by looking at this, these are all orders that are coming in. This is Dash Trader Pro, the same thing. These are all orders that are waiting to be filled. These are all orders waiting to sell. The charts are a historical record of what has happened. Level 2 shows us what's going to happen. So while I am in a trade, my eyes are watching level 2. I am watching where the bid and the ask are. That way, if this drops to my profit loss, so somebody is bidding or wanting to buy, if it's gone down to my stop loss, I know immediately to hit the sell button to keep tight on that stop loss. This will also tell me where people are wanting to sell their shares. So I'll focus on the top 2 to 3 lines to see what price action, where the bid, where the ask is, so I know what is coming. We also see all these stacks of buyers, and we're going to get into this in a later class. But again, if I'm in a trade, my eyes are right here on level 2, and then I am watching this peripheral. If you see green, that means it's buying at the ask, or it is being bought at where somebody is asking to sell their shares. White is between the spread, between the ask and between the bid. And if you see red, that's typically either at the bid or below the bid. So if I am watching, and let's say I entered this stock, this particular one, at $2 a share, and I have a $2.50 profit taking, I'm going to be watching where the ask and where the bid are, and then watching over here for a bunch of green purchases or orders to come through, a bunch of green orders to come through. That tells us that buyers are coming in, and that stock, the price will begin to go up. It happens actually very quickly. The same with Thinkorswim. My eyes are focused on the bid and the ask, and I'm watching for that green or the tape, and we're going to get into that in later training, but watching that either to be green or red, watching buyers coming in and pushing the value of that stock up. So when you're in a trade, I highly recommend that you focus not on the charts, but focus on level 2 where the actual bid and where the actual ask are. That tells us where the buyers and the sellers, if they are stacked up. So position management, watch not the charts, watch the bid and the ask so you know where the entry and the exits, your stop loss and your profit loss. That's the best way to manage a position that you are in. Now, I want to talk a little bit about scaling up. Scaling up, we've got to actually define this because there's different terms out there, scaling up and scaling in and out. So let's define what scaling is. So scaling up, this is increasing your entry size when you have a proven track record, you have increased confidence, and you have an increased ability to set good stop losses. You're increasing your entry size before you get into a trade. Scaling in and out, which is going to be in a later class, this is adding or selling a portion of an existing position you have as the stock goes up and as it hits profit targets. We are going to be covering this in detail in a later chapter. So what we are really looking at right now is scaling up, not scaling in and out. Right now, especially if you are a beginner trader, I would do one entry in, one exit out. Don't try to sell portions of your shares yet. Just get in, get green, get out. And then as we become more profitable, as we become more consistent, we will talk about scaling in and out in those shares. So scaling up, first you want to start with very small positions if you are a beginner trader. When you have that proven track record, then you want to begin to add share sizes. This is something that I've come up with. This is called the principle of doubling in trading. The principle of doubling. So scaling depends on really where you start. So if you are starting with 10 shares, maybe you're just at 10 shares. As you become profitable, you have a bit of a proven track record. You take that 10 shares and you double it. Now you start trading with 20 shares. Maybe you started with 50. As you have, and when I say a proven track record, I'm not talking one or two trades, 2 to 3 weeks of proven profitability with a high risk to reward ratio and high accuracy. Once you have that proven track record, if you are trading currently maybe 50 shares, double that and start trading with 100 shares. You're going to follow the same entry, the same exit, the same stop loss. The process is exactly the same. The only thing that changes is your share size. If you have started with 100 shares, once you have that proven profitability, increase that, double it to 200 shares. Once you've gotten to that point, maybe you jump up to 250 shares. Once you've begun profitability there, jump up to 500. Again, it is the same entry, same exit. The process is the same. The only thing that is changing is you are scaling up on your entry level. I would caution you this: if you have a max loss early in trading, what I would do is go back to those smaller positions again to gain that confidence. So if you have a max loss in one day or one trade, then scale back, start small, and begin to build that back up again. And I have warned you almost every single class, never, ever, ever risk your entire account on one trade. Again, that goes back to account management. The point of scaling up is once you have proven profitability, we want to follow the principles of doubling. So whatever shares that you are currently trading, once you're profitable, you're consistent in that, then double the share size. Once you are consistent there, then double it again. What this does is a few things. Number one, it creates mechanics and muscle memory for entry and exit, but also it will help you with that emotional tolerance as you begin to trade with real money. And if you get to a point to where it is becoming too emotional, then back down your share size until you are comfortable with that. Never trade under emotion. It creates bad decisions. Risk management is really one of the most important things that we need to get a hold of and understand well to be profitable as a day trader. Remember, if you don't know your risk, you really are gambling. When you enter into a trade, you need to know before entering what your profit target is, but more importantly, what your stop loss, what your risk threshold is. Understand your risk to reward. Watch for those 1 to 2 to start, the 1 to 3, and the 1 to 4. Those consistent base hits are what's going to create profitability. We are going to have those others that are 1 to 10, 1 to 20. They do happen, but consistency, profitability, and those risk to reward. Make sure you're managing your account. Be cautious of how much that you're entering. Watch your position management. Start very small. one entry in, one exit out, and then as you see that you're profitable, begin scaling up in size. So manage risk, because day trading is risky, but it is not gambling if you understand risk and understand how to manage this. Hopefully this class has been helpful for you. It gives you the information that you need to manage risk. And as always, we are praying for God's favor and blessing over you and your family. God bless you. Thank you for watching.